Assalamualaikum and good day everyone. My name is Nurul Binti Suid. In this presentation, I will provide the introduction and company background of our comparative financial analysis. The purpose of this report is to compare the financial performance of Apollo Food Holdings Berhad and Seng Industries Berhad, two established company in Malaysia, fast-moving consumer goods (FMCG) sector, particularly in the snack and food manufacturing industry. By analysis their financial statement for the latest 2 years, this study evaluates key aspects such as profitability, liquidity, efficiency, solvency, and market performance to assess their overall financial health and competitiveness. The Malaysian snack and processed food industry is an important part of the FMCG sector, supported by their lifestyle urbanization and consistent demand for convenient foods products. However, companies in this industry face challenges such as intense competition, price-sensitive consumers, and strict food safety regulations, making cost efficiency essential. Moving on the company background, Apollo Food Holdings Berhad, listed on the main market of Bursa Malaysia, specializes in chocolate, confectionery, and layer cake under its well-known Apollo brand. The company operates automated factories in Johor Bahru and exports its product internationally. Meanwhile, Seng Industries Berhad, also listed on the main market, focuses on biscuit and cracker, including its iconic Chuck Ping Pong cream crackers. Established in 1958, the company is also recognized for its strong dividends policy and stakeholders' values. In conclusion, although both companies operate in the same industry, their different product focuses make them suitable for the meaningful financial comparison.
Based on our methodology, this study applies a qualitative approach to analyze and compare the financial performance of Apollo Food Holding Berhad and Seng Industries Berhad. We use secondary data obtained from reliable and official sources such as the company annual report, financial statement, official website, and Bursa Malaysia. Using verified data ensure accuracy and strengthen the credibility of our analysis. To conduct a systematic comparison, we apply financial ratio analysis, which is widely used to evaluate a company's financial condition. The ratios are grouped into 5 categories, namely liquidity, efficiency, profitability, solvency, and market ratio. This ratio allow us to assess each company's ability to manage short-term obligation, utilities asset efficiently, generate profit, manage long-term debt, and attract investors. Overall, this methodology enables a clear, structured, and objective comparison of both companies' financial strength and weakness, providing meaningful insight into their overall financial performance.
I will be presenting the financial ratio analysis of Apollo Food Holdings Berhad for the financial years 2023 and 2024. Apollo Food Holdings Berhad operates in the food manufacturing industry and has an established presence in the Malaysian market. The purpose of this analysis is to assess the company's financial performance and stability by examining key ratios, namely liquidity, profitability, efficiency, solvency, and market ratios. These ratios help us understand how effectively the company manages its resources and generates value for stakeholders. Firstly, we look at liquidity ratio, which measures the company's ability to meet short-term obligations. Apollo recorded a current ratio of 21.86 times in 2023, which declined to 12.00 times in 2024. The quick ratio also decreased from 18.50 times to 10.30 times. Although these ratios decline, they remain well above the standard benchmark, indicating that Apollo continues to have a very strong liquidity position. Next, we analyze profitability ratios. Apollo's gross profit margin increased from 25% in 2023 to 29% in 2024, showing improved cost control. The operating profit margin rose from 15% to 25%, while the net profit margin increased from 12% to 21%, indicating stronger overall profitability. In addition, return on asset improved from 12% to 22% and return on equity increased from 13% to 24%. These results suggest that Apollo utilized its assets and shareholders' fund more efficiently in 2024. Moving on to efficiency ratios, which measure how effectively resources are utilized. The inventory turnover increased from 9.56 times to 10.51 times, indicating faster inventory movement. The average collection period remains stable at around 38 days and account receivable turnover stay consistent, reflecting effective credit management. Meanwhile, total asset turnover improved slightly from 1.00 to 1.03 times, and fixed asset turnover increased from 3.18 to 3.38 times, showing better utilization of assets. Net solvency performance. In terms of solvency, the company reported zero debt in both years, with a high equity ratio of 0.93 in 2023 and 0.91 in 2024. Reflecting strong long-term financial stability and minimal financial risk. Next, with Azman market ratios, Apollo's earnings per share were RM0.6766 in 2023 and RM0.3956 in 2024, indicating lower earnings per share in 2024. The price-to-earnings ratio declined from 16 times to 9.35 times, suggesting that the company's share price became more attractive relative to its earnings. At the same time, the market-to-book ratio increased from 2.13 to 2.26, reflecting continued investor confidence in the company's future prospects. In conclusion, Apollo Food Holdings Berhad demonstrate very strong liquidity, a debt-free capital structure, and significant improvement in profitability. Efficiency ratios indicate stable operational management, while market ratios suggest positive investor perception. Overall, the financial analysis shows the Apollo Food Holdings Berhad in financially stable, well-managed, and well-positioned for sustainable long-term growth.
Hi, Assalamualaikum and good day everyone. Today, I will be presenting the key financial ratio analysis of Seng Industries Berhad for the financial years 2023 and 2024. This analysis focuses on how the company performed financially over the 2-year period. This analysis evaluates Seng's financial performance using key financial ratios, which are grouped into 5 main areas: liquidity, profitability, efficiency, solvency, and market performance. The objective is to assess the company's financial strength, operational efficiency, and overall stability from 2023 and 2024. Okay, moving on to liquidity ratios. Seng current ratio declined slightly from 2.27 in 2023 to 2.01 in 2024, while the quick ratio decreased from 1.83 to 1.61. Refer to bar chart. As shown in the chart, although liquidity decreased, both ratios remain above the benchmark of 1.0, indicating that the company is still able to meet its short-term obligation comfortably. This suggests more efficient working capital utilization rather than financial weakness. Next is profitability. All major profitability indicators show improvement in 2024. The gross profit margin increased 31.30%, operating profit margin to 17.59%, and net profit margin to 14.57%. In addition, ROA increased to 22.9%, while ROE rose significantly to 35.2%. Refer to the chart. These results indicate better cost control, stronger operational efficiency, and higher return generated for shareholder. For efficiency ratio, Seng show overall improvement. Inventory turnover increased from 8.3 to 8.8 times, indicating faster inventory movement. Total asset turnover improved to 1.57 times, while fixed asset turnover increased slightly to 4.8 times. However, the average collection period increased slightly to 40.10 days. Refer to the bar chart. Overall, asset and inventory utilization improved, while receivable collection remained within an acceptable range. In terms of solvency, Seng recorded a debt-to-equity and debt-to-asset ratio of 0.0%, indicating minimal reliance on debt. The equity ratio remains strong at 65%, reflecting a solid capital structure. For market performance, EPS increased from 0.017 to 0.06. The PE ratio declined and the market to book ratio increased to 5.8, showing improved valuation and investor confidence. In conclusion, Hazwanie industry Berhad demonstrated strong financial performance from 2023 and 2024. Profitability and efficiency improved significantly. Liquidity remained healthy despite a slight decline, and the solvency position is very strong and minimal debt. Overall, the company shows financial stability and sustainable growth potential.
Today, I will present a comparative analysis of the financial performance of Apollo Food Holding Berhad and Hazwanie Industry Berhad for the years 2023 to 2024, focusing on liquidity, profitability, returns, efficiency, solvency, and market performance. First, in terms of liquidity, Apollo shows extremely high current and quick ratios, indicating strong short-term financial strength. However, from a critical perspective, this may suggest inefficient working capital management due to excess idle cash. In contrast, Hazwanie maintains more balanced liquidity ratios, reflecting better control and efficient use of current assets. Next, looking at profitability, Apollo demonstrates stronger improvement in operating and net profit margins, showing effective cost control and operational efficiency. Meanwhile, Hazwanie records a higher gross profit margins, indicating stronger pricing power, although its operating expenses reduce overall profitability. Overall, Apollo shows stronger short-term profitability growth, while Hazwanie offers more stable performance. For return analysis, Hazwanie outperforms Apollo in return on equity, indicating better value creation for shareholders. Apollo's lower ROE is mainly due to its conservative capital structure with high equity, which reduce financial risk but limit shareholders' returns. In terms of efficiency, Apollo performed better in inventory and receivables management, while Hazwanie shows stronger asset utilization. This suggests Apollo excel in operational control, whereas Hazwanie benefits from scale efficiency. Regarding solvency, both companies are financially very strong, operating with minimal or zero debt, which significantly reduce financial risk but may also limit growth potential. Finally, for market performance, Apollo records higher EPS growth, but Hazwanie enjoys stronger market valuation and investor confidence, as reflected in its higher market-to-book ratio. In conclusion, Apollo demonstrates stronger operational performance and profitability, while Hazwanie stands out in shareholders' returns, efficiency, and market perception. The better company ultimately depends on whether investors prioritize growth or stability.
Based on the financial ratio analysis, both Apollo Food Holdings Berhad and Hazwanie Industry Berhad show positive financial performance in the food manufacturing industry. In terms of liquidity, Apollo records a very high current ratio, which shows strong ability to meet short-term obligations. However, this also suggests that some current assets may not be fully utilized. In contrast, Hazwanie shows a more moderate liquidity ratio, indicating better working capital management. For profitability, both companies perform well. Apollo shows improvement in profit growth, while Hazwanie demonstrates more consistent profitability over the years. In terms of efficiency, Hazwanie shows stronger asset and inventory management compared to Apollo. Regarding solvency, Apollo has no long-term debt, which results in low financial risk, whereas Hazwanie maintains a balanced capital structure that supports stability and growth. Overall, Hazwanie reflects stronger market confidence. In conclusion, both Apollo Food Holdings Berhad and Hazwanie Industry Berhad are financially strong companies. Apollo performs very well in liquidity and has minimal long-term financial risk. However, its high liquidity indicates that some resources may not be fully optimized. Hazwanie, on the other hand, demonstrates consistent profitability, strong efficiency, balanced liquidity, and positive market performance. Based on the overall analysis, Hazwanie shows stronger and more balanced financial performance. Based on the findings, several recommendations can be made. For Apollo, the company should improve the utilization of its current assets by relocating excess cash into expansion activities, strategic investments, and product development. The use of a balanced capital structure may also support long-term growth. For Hazwanie, it is recommended that the company continue maintaining effective cost management and operational efficiency. Expanding into new markets, particularly export, can further strengthen its market positions. Overall, continuous monitoring of financial performance is important to ensure long-term sustainability.